So now in the previous class we have seen about the cost of inventory. Okay, so we have understood, and good questions are lying there on the cost of inventory. So they may ask you some more questions on that. So now we will look into the inventory valuation technique. See, first thing is you will figure out the cost, but which cost you are going to allocate? Cost is what? Okay, this is my cost which should go, but the inventories are continuously moving. So whether I am going to follow the FIFO method, LIFO method, or whatever cost accumulated, I am going to use this specific identification method, that goes with your business practice. So let us try to understand here. There's a theoretical aspect first. Like, what does this cost includes? What does this inventory valuation techniques include? See, this inventory valuation techniques are broadly classified into two categories. First, you need to check, can I interchange the inventory? Can I mix the inventory? Or inventory is it identical? Or it is not interchangeable. If it is not interchangeable, interchangeable means suppose you have got nuts and bolts. Can you use it for this fan also, for some machine also? Probably you may use it. So you keep it aside. Not interchangeable, that means this particular asset is meant for this only. Then you can probably go for the specific identification method. Like, why did you purchase a fridge? I purchased a fridge only to keep that mangoes imported from Japan. And none of the other items are required to be kept for this. See, I am telling you, it is not, fridge is not an spare for that. Means it's specifically identified. I can tell that, look, this cost is meant for this, so I start capturing it. So you can go for this method, and this is the best method. This is the most reliable method, fantastic method. Always try to give first priority to specific identification. Even though you are mixing, if you can specifically identify, well and good. Otherwise, you have to go to better estimations. Now, if it is interchangeable or you cannot identify it specifically, yes, there are two methods again in that. One is the historical cost method. That means based on whatever cost you have incurred, you go that, or non-historic cost method. And in historic cost, either FIFO or weighted average is permitted. LIFO is not permitted now. And in the non-historic cost, in non-historic cost means you don't look at the cost here. You go for either retail method or a standard cost method. That also goes with your business practice, and it is permitted. Here it is an estimation. Look, you think that this must be my cost value. Like simple, in short, like you go to that vegetable vendor, rather than asking his invoices, God knows, will he keep any invoices? All telephonic calls and all this will happen. Does he maintain perpetual inventory? See, let us discuss at this point of time. There are two types of inventory, probably we may get that also. Perpetual inventory method and periodic inventory method. In perpetual inventory, what happens, the moment any movement happens, your stock will get updated. Reports will get updated. Like for example, you have gone to the, have you seen any perpetual inventory? Come on, you have seen, Baba. Sorry? Which one? Banks, no. No, which one you say? Yeah, which example you said? Which institute or something you said? Not general. Have you seen in reality? See, medical, simple. You go to a medical. The moment that they issue some medicines to you, say for example, not everyone, they make an entry. Next time, when you go and ask them, they check the system and say, no stock. Have you seen inside? No, but they say, they look in the system and say, stock is not there. See, this is the methodology, like it is your business practice. That's what I am telling you. It's the periodic. No, it's not periodic. It is perpetual. Perpetual means the moment issue happens, I make an entry. The moment receipt happens, it make an entry. That is different. That is a different thing. Filling, you have got reorder level and all those things. It's the method of maintaining inventory. Now, what difference it makes also, I'll tell you. Now, in a periodic inventory, at any point of time, you can know the stock. How? Look into the stock records. Whether it's physically there or not, that is different story. Somebody might have stolen also. But you always get the book value of the stock by looking at the records. Followed, no? So what you get is the COGS. You calculate the COGS here, cost of goods sold, because book value of the stock is always available to you. Now in periodic inventory, for example, this vegetable vendor or fruit seller, you go to that fruit seller, do you think he has maintained the moment he makes payment, he will enter, nothing on a sheet of paper, he will make one record. No, he doesn't know. Okay, if you want to know what is my stock, he is left with no choice other than go and first count that. Then only he will come to know what is left within his hand, because he has not maintained any records of any inventory. That is a periodic. In a periodic, you go and first balance, you first figure out the, I have just interchanged it. In a periodic, stock is the balance, COGS is the balancing figure. Why? Because at any point of time, you want to know the stock, you go and physically count it. Okay, he will weigh how much orange is there, how much mango is there. He will fix the value to it. And opening stock is there, purchases are known, closing stock is available, COGS becomes the balancing figure. See, in this periodic inventory, every issues you know, you have recorded. Opening stock is there, purchases are there, closing stock is there, issues are there. So stock becomes the balancing figure. Then this you go and verify there. Is the balancing figure here. At any point of time, you can find the closing stock. You understood this methodology? See, now at a periodic stock, now this question comes, how the issues are going to happen here. Okay, because this application we are going to find, at that time I'll explain you more. But in principle, have you understood about the periodic and the perpetual? So in a periodic, now what may happen? No, see, since he has not maintained any stock records, any purchase records, what is the value of the stock? Simple. He says, look, I don't want to complicate the things. Okay, because I don't have any record only to ask me. If you are asking me, are you mixing FIFO, LIFO and all? First of all, bill should be there in my hand. No, I don't have a bill only. Everything is happening in telephonic call. Does not mean that I don't have a stock. I have the, no, you see, it is in front of you. Should I not value it? For a true and fair statement, I should value it. Then how to value it? Simple. See, I know my market price of the realizable value. I know what I should value. Value is cost or fair value, cost or NRV, whichever is low. Realizable value, I know. You just weigh everything. In a sheet of paper, I will make a note. Okay, I have got 10 kg tomato, 20 kg sugar. Like, for example, you note down by physically weighing it. Into, I know my market price. And generally, say I earn 10% margin. If I remove that, is it a best approximation of the stock? That's called a retail method. It's also fine, acceptable. When you don't have this, then what I can do? See, accounts is only one supporting function. It is not a business driving function. Accounts cannot go and interfere in your business. They will slap. Accountants don't have that right to go and stop the business there. What business happens, we have to account it. Followed, no? So now I cannot overburden the business, like do a lot of compliances because I want to pass one accounting entry. They say, Arey Baba, should I do the business here or should I sit and make any records for you? So this method is also fine, acceptable. So we have to maintain a balance there between business and the account. That does not mean you can do whatever you want. Huh? We will not permit that also. So understood? The standard cost is something like I fix the standard cost for that. So how many quantities are there into standard cost? That is my value of the inventory. That means pure estimation. It is non-historic. Your cost may be anything, but you value at so and so price. So always give first priority to specific identification. Not possible, historical cost. Not possible, then estimations. Ultimately, our financial statement is made up of estimations. Now, what about the raw material? Problem is with if it was a orange, apple, I know this is what I am selling, but I have got certain raw materials which I convert. Raw material I don't sell, no. What I sell is a finished goods. So what is the cost of raw material? Then they say that raw material and other supplies held for use to produce the inventory. Like I have got something like plastic covers are there. I don't sell it, but I have got the stock of plastic cover because I put this apple into the plastic cover and give to the customer. What is my value of the plastic? What is my inventory value of the plastic cover? That's what they say, that look, if you can sell the finished goods, because you don't sell plastic covers on a standalone basis there. Are you selling that? No, you are using it as a along with one like a CGU concept. So if the raw material, if the finished goods are sold at above cost, irrespective, even though that NRV of the raw plastic cover has fell down, you value at cost on. You don't degrade. Why? It's the same concept like my CGU impairment. If your one machine, one fan has got impaired, but the CGU as a whole has not been impaired, yes, you need not impair that, provided you assume that you continue to use it, you don't have any plans to sell it. But if you have got a plans to discard this plastic covers because it is something like problematic plastic cover, then you discard it, you bring it less than the cost. Same like what you principles you follow during the impairment of the PPE or CGU, the similar concept will be applied for this. And if the finished goods are sold at NRV, yes, then raw material shall be at the replacement cost, which is nothing but it's NRV, because you cannot sell the, what is that called, raw material, but at what value you can replace it, that is its market price. So you should measure at its NRV. Are you clear? Yeah, tell me which. Sorry? Replacement cost means, if, see, the finished goods itself valued less than cost, that means you are selling it, first of all, apples you purchased, your cost is 100 rupees, and next 2 days you understand that your, what is that, suppose lockdown is going to happen, so you sell at a throwaway price of 80 rupees. First of all, here only you are making a loss, and the plastic prices have also come down. Previously, the plastic prices had come down, but you used to value at the price what you have purchased it. Even though you had got a stock, go down, one big bundle of plastic covers are there, which you wanted to use for next 1 year. What is the value of that plastic cover? You know its cost. But if the finished goods you could have sold at above the cost, then you would have measured at cost, not at its NRV. But if the finished goods are sold at or valued at less than cost, then generally raw material I should have valued at net realizable value. But I don't have any net realizable value for plastic, no, because I'm not a plastic seller, I'm a vegetable seller or I'm a fruit seller. Then I will go and find out, okay, if I have to buy one new raw material, say new bundle of plastic, what is its value? It's my cost of purchase, it's not NRV, they understand both, which is nothing but an NRV for somebody else. For a plastic seller, that is an NRV. You will be selling it, that means it should be valued at its replacement cost of the market price. Clear, no? Yes, next concept we will see NRV. Before that, we will solve some problems on the inventory valuation techniques. Yes, take out question number 7 of RTP. A retail company imported goods at a cost of 1,30,000, including 20,000 non-refundable import duties, which should be part of my cost, and rupees 10,000 refundable purchase taxes. Now, which is including? Both are including, or non-refundable tax is included and refundable tax is excluded? Both are included. See, two perspectives, the way you look. See, this is what confusion, no? See, everybody, if you say everyone, a retail company, does everybody understand? Somebody will say retail company will sell machine and all something. No, everybody can visualize one thing, you can understand one thing. But the moment you come at this point of time, two people can take two differences. Follow, no? First try to identify such things can happen. Then you have to give your assumptions. It is a subject matter, it may be a subject matter of assumption. No, because somebody can assume, no, see, if everybody speaks one, then there is no question of assumption. But here you only see in the classroom, only we will see some group of people say that 20,000 is included in 1,30,000, 10,000 is not included. Somebody will read it, both are included. That's what perspective of, I am not denying that. The risk, rewards and ownership of the imported goods were transferred to the retail company upon collection of the goods from the warehouse. That means you have become the owner of it. The retail company was required to pay for the goods upon collection, and they incurred 5,000 rupees to transport the goods, further 2,000 to deliver it to the customer. For the selling cost is 3,000 rupees incurred in selling the goods. State whether the delivery charges and selling expenses will form part of the inventory. If not, so okay, but this only will understand no. Why? And also calculate the cost of the inventory. 3 questions. Yes, is it part of the inventory? Okay, why? Yeah, sorry. It is not the cost incurred to bring the present location and condition. Okay, so this is what you are going to say. And okay, you have explained. What is my value of the inventory, cost of the inventory? Can you tell me? Yes, it's more like a theory question. One lakh? 25,000, any other number? Everyone agree? Yes, Julia. 1 lakh 25? 1 lakh? 20,000? Okay, so we'll do this. Just one will small, because since I put it here, otherwise I would have discussed it as a theory. Okay, right? Cost of inventory. Theory, you can leave it. We can discuss later. Cost of inventory. See, my cost of inventory includes purchase price. What is my purchase price? Sorry? No, no. Which? No, 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 no. Again, see, again, this is a very, what is it called, not a multidisciplinary. And they themselves have told that what exactly happens, really happens right now. Because we know that something we don't, they may fool us like this. One very clearly, one item we know that it is not applicable for taxes. I know that this problem comes in somewhere it has come, some STT, security service tax, dividend distribution tax, certain things which is not existing, like in the classroom also that question came, irredeemable preference shares. But at one point of time they have told in one note that this is only for illustration purpose, only to understand it. But what is happening in reality in that other subject matter, you don't consider it. Absolutely not required. Clear, no? Unless it is paper number 4. Multidisciplinary. 6 or 4, what a 4th paper, right? Okay, 6th paper, shifted. Okay. Last paper. There, be careful. You may have to think from that angle. No, probably see, there are 2 things. One is case scenario and the case study. What is the difference? Case scenario, small, case study is big. No, case scenario can be big also. Which is easy? Scenario is easy, no? Case study is easy. Okay. I'll just tell you so that you, in audit, you will come across now, because in the new syllabus audit, they have added case scenario, case study. I also, first I thought it is same. Then later I understood. See, in case scenario, what happened now? They give you one mixture, okay? But each para you can identify. There is no relationship between these two. I can just, it's like a plug and play. I will take something from here, this is first para, second thing I plug it, this is third para, this is third, fourth para. There is no interconnection. You can read it independently. You can write you can just go to the MCQ, you can answer that MCQ. There is no headache. That's why in the exam they will not tell you, giving heading, this is case scenario. But you should, by looking at it, you should be able to make out, so that you can develop your strategies to address it. But in a case study, what happened? No? They give you one single consolidated, which has everything there. So the distinction, no, from where you reach to where, it becomes very difficult in the case study. Here it's a very clear cut. In your mind, you can just add one underline there. Finish. That para you need not go and collect down somewhere down. So if you get case scenario, it's very nice. Fat you can do. But if you have to answer the case study, you should have understood full, not on part to part basis. Clear, no? And now again in the new that multidisciplinary, we have to see what type of, is it a case integrated business solutions, they say. Preferably they may ask you this. There you may have to think what exactly is the provision related to this, because it's one business solution, not a scenarios. Clear? They have added this stuff. But it's fairly simple, very nice. That's what case scenario is, and case scenario they were asking also earlier. MCQ. Okay, what is my purchase price? Sorry, 1,20,000. Okay, so you can say that 1,30,000 minus refundable taxes, assuming that 10,000 is also included in that. Alternatively, I don't know whether here or some other problem, I will tell you that institute has taken that, okay, no, if you assume it to be separate, then just leave it. It's 1,30,000 is the purchase price, if you assume it to be separate. Then import duty, you are going to add 20. Are you not going to add a transport cost? 5,000. Without this transport cost, will you get this? Now there is one more transport cost. One minute. Yeah, 1,30,000 including 20,000 non-refundable import duties. Oh, sorry. Yeah. It is not added. It is already part of here. Maybe in the presentation I will given you separately. And the transportation cost should be added, not to what is delivered to the customer. So total comes to 1,25,000. So clear, no? Other theory you can leave some. Which one? This transport cost is to get the material, no? The retail company incurred 5,000 to transport the goods to its retail outlet. From the import, from the warehouse, you got it here, and from here you incurred 2,000 and delivered. So that is not applicable to you. Okay, so then you say that purchase cost is going to exclude the transaction paid. If you want, you can leave some space. But how do you write the theoretical part, why and all? So you have to explain like this. Okay, not required now. Ind AS excludes the selling cost. They asked you why. However, selling and distribution costs are generally used as a single term, forming part of the inventory. But what about the distribution cost? Because both are related as a selling cost are incurred to effect the sale. The distribution costs are incurred by the seller to complete a sales transaction by making the goods available to the buyer at a point of sale to the point at which buyer takes the possession. See, one you have got a selling cost and this is the distribution cost. Generally we call it sales and distribution cost. Now should I include that 2,000 rupees distribution cost? That's what, no. Since these costs are not related to the bringing to their location and condition, you need not include accordingly, even though the distribution cost is not specifically mentioned in Ind AS 2. They said selling cost should not be part. Have they told you distribution cost should not be there? But that 2,000 rupees is a distribution cost, it is not a selling cost. Now should it be part? That's why you say that even though it is not specifically mentioned, 3,000, so by default you will exclude it. But what about the 2,000? You are going to exclude because you interpret distribution is part of the selling. Understood now? New perspective. So this is what you need to write. Simply if you say that, look, selling cost, it's not a part. Baba, your interpretation is wrong because first of all, that 2,000 rupees is not a selling cost. It's a distribution cost. So are you going to write in the examination that, yes, it's a distribution cost. We have identified it. Ind AS 2 is silent about it. But we interpret distribution as a selling cost. This is the answer you need to write. Now question number 8. From the following data, calculate the COGS and value of the closing stock. So the FIFO method and the weighted average method. So opening inventory is there. Actual cost 2.10. Sales purchases, purchase sales are happening, and you got the closing units here, correct? No, total units available, opening inventory 150. Yeah, difference between the total units purchases plus opening stock minus the units sold becomes your closing stock. Now, what is the value of the closing stock? That depends upon whether you follow FIFO or weighted average method. Otherwise, you can't never follow that. Otherwise, forget this method and go to some other method. Because we have seen here what should come here in the actual cost per unit. Whether overhead should be part of it, whether selling cost should be part of it. That's what we have calculated. But which is that closing value? Closing stock should be valued at which price? Whether the opening cost should be component should be included or not. That's based on this. Okay. So write FIFO method. So what is my value closing stock? How much quantity I have got? Total closing stock. Can I say 300? Wait, 150. Yeah, 300 total they have given. Opening stock plus 200 rupees, 200 quantity purchase. Minus 175. How much you get? 125. 125 is the closing stock. So if you follow FIFO method, how do you value this 125? So go for the last purchases. So what was your last purchase? 50 units. At what rate? 3 rupees. But did you get this 125? No. That means balance 75 units must be from the previous purchases. So what is your previous purchase? 150. At what rate? 2.8. So taken together, you have got 360. Followed, no? 50 quantity from the last purchases. If the last purchase itself was 300, entire closing stock I would have told from the last purchase. Okay? Yes. Doubt? Sorry? See, when I say first in, first out, what you issued first is from the opening stock. FIFO means what stock remained. That is from the closing, that is from the latest purchases.